Meeting is being recorded.
Thank you. We'll just give everyone about 30 seconds to enter the webinar. Okay, I think we might kick things off. Good afternoon, advisors and guests, and welcome to our 5th annual Asteron Capital Guaranteed Fund Results and Review webinar in partnership with our colleagues from TAL Investments and Janice Henderson. It's fantastic that you could take some time out of your day at this very busy time of year to hear about what's been happening with your super fund. As you would have seen in our recent communications to you, on the 31st of May this year, Brighter Super improved our fee arrangements and delivered streamlined investment options in line with our commitment to improve our service offer and reduce costs. I'm pleased to say these changes were delivered as scheduled, and where relevant, your clients' investment switches were processed successfully. Now, today's presentation will provide you with an update on the Asteron Capital Guaranteed Fund, which is closed to new members. I'm Nikki Lees. I'm Senior Manager Advisor Growth at Brighter Super. I'm joined online today by my colleagues, our Head of Advice, Stephen O'Donoghue, our Business Development Managers, Sean Cogman and Daniel Pute, and from our investments team, Scott McCallan. Now, before I start today's briefing, on behalf of Brighter Super, TAL and Janice Henderson, I'd like to acknowledge the traditional owners of the lands on which we're meeting and pay our respects to their elders past, present and emerging. We acknowledge and celebrate the continuation of a living culture that has a unique role in this region. Now, as I'm sure you're aware, this presentation is general advice only. It has been prepared without taking into consideration your financial situation, circumstances and needs. Today's presentation will run for about 1 hour, and that will include some time for questions at the end. Thank you for the questions that have previously been submitted, and we will address those throughout the presentation. If you do have any questions throughout, please use the Q&A box, which you'll find at the bottom of the screen, and we'll answer those questions as we go. And as I said, there'll be some time for questions at the end. Now, our presenters today join us from TAL and Janice Henderson. We have Scott Vincent, Investment Governance Manager at TAL, Josh Corrigan, General Manager of Actuarial, Appointed Actuary at TAL, and Sian Kui, Portfolio Manager of Credit at Janice Henderson Investments. So I'd now like to introduce Scott Vincent, TAL's Investment Governance Manager, to kick off today's presentation. Thank you, Scott.
Thanks very much, Nikki. As you say, this is the annual update on the Asteron Capital Guaranteed Fund for the financial year, and we are absolutely delighted to be here to be able to present this to you, so thank you again. If we just move to the next slide, there's a disclaimer here which we prepared that we could invite you to read at your own convenience. Next slide, please. As Nikki said, that's me on the left here. I'll be presenting to you as Investment Governance Manager of TAL. I oversee the management and governance arrangements of TAL's policyholder assets. I'm joined today by General Manager Actuarial and the Appointed Actuary of TAL, Josh Corrigan. Josh has deep actuarial and financial risk management expertise. He's recognised as an industry leader in these fields. Also joining me from TAL today are Sean Bransden, Head of Product and Retirement, Scott Manson, Head of Pricing and Investments, Nikki Marriott, Senior Partnership Manager, and Dan Gethin-Jones, Partnership Manager at TAL. So the purpose for today is to update you all on the crediting rate outcomes for the Capital Guarantee Fund and the rationale for those outcomes, which Josh will talk us through shortly. Following that, I will be giving a brief update on the fund overall, and then I will pass to Sian Kui of Janice Henderson, who will provide a market outlook. Just before we get to those points, though, I'd just briefly like to run you through the value proposition that's presented by the Asteron Capital Guaranteed Fund. So if we move to the next slide, please. One of the critical benefits of the Capital Guarantee Fund is that capital guarantee that's provided by TAL, which is an APRA-regulated institution. In addition to that, policyholders achieve potential upside participation when market conditions are favourable. And thirdly, upon withdrawal or surrender of the policy, payment of proceeds is made the following day, so one-day liquidity under this product. Overall, we believe the capital guarantee in particular provides a very strong value proposition in this uncertain environment that we find ourselves in. So with that, I'd just like to now invite Josh to speak to the crediting grade outcomes and the rationale for those. Thanks, Josh.
Thank you very much, Scott. So I'll run you through a few slides in terms of the outcomes and how the fund has performed over a number of years relative to its benchmark member objective and some of the other alternative asset classes. So what you can see on this slide in the top left-hand box is the outcome in terms of the declared rates, the special rates, and the aggregate crediting rates for the fund for this year. So between super and pension, the declared rates 2.25 to 2.5%. We have an additional special bonus of 45 and 50 basis points on top of that, bringing the aggregate declared rate, or the aggregate rate, I should say, to 2.7 and a fraction over 3% respectively for super and pension business. It's probably important to note that there's a number of factors that goes into setting those rates for any particular outcome or any particular year. And the declared rate in particular reflects some important factors around not just recent or 12 months performance of the fund ending 30th of June, but also considers a bit of the past history of returns, as well as the forward-looking expectation of returns. So one of the key features of this portfolio, in addition to what Scott mentioned around the capital guarantee, is we aim to smooth rates or smooth declared rates over the investment cycle. That becomes particularly evident on the next slide. But when we do that, we aim to ensure that we pay out all returns or profits that the portfolio earns over the course of around about a 5-year period, which means that in any given year, the declared rate kind of reflects a bit of the past and a bit of the future and a bit of the current. So it's a bit of a blend of all those elements. The special bonus rate distribution for this year, again, is guaranteed once it's been declared. So 45 and 50 basis points is the distribution of the inherited estate that continues to support the risks and the capital position of the portfolio. And so whilst it's not guaranteed in advance, once we declare it, it is guaranteed. If you move to the next slide, please. What you can see on this slide is a bit of a history of the declared rates. And for what it's worth, I've been involved in managing this portfolio as an appointed actuary for about 10 years now. And over the course of that time, what you can really see, particularly in the last decade or so, is an element of smoothing that's come into the declared rates. It's been a pretty good period of time. You can see on the right-hand side that the fund has generated a bit over 4% over a 10-year basis, which is outperforming the member objective by about 40 basis points. You will note what you can see on that graph is the member objective, which is a function of CPI. So it's a CPI over a 10-year period with 50 basis points added on top. And clearly, the last few years have been quite challenging given the high inflation rate environment. And the inflation outlook, I guess, is looking better than it has been for a while. Inflation has come down, and It is still coming down, although it remains probably a little bit above people's expectations at the moment. I do expect that as inflation rates come down, then that will continue to support the relativities between the fund and that member objective. Over the last decade or so, you can see that returns have been incrementing down broadly in line, not quite in line, but broadly reflecting the relaxation of monetary policy over the last decade, culminating in what happens at the start of COVID and subsequent has reversed quite significantly in the last couple of years. But broadly, over that course of time, the fund, through its smoothing principles, has continued to outperform that member objective. If you flick to the next slide, what we tend to do is, as I said before, one of the core features of the portfolio and how the portfolio is run is it aims to smooth out some of the investment market fluctuations from period to period. And what you're seeing on that slide is the earned rate in the blue, which is obviously volatile from year to year, reflecting what happens to interest rates and equity markets and other growth assets. And so we aim to try to smooth out those that volatile investment profile, to buffer particularly the downsides that occur from time to time, such as what did occur at the start of COVID in 2020. And more importantly, even more recently in 2022, people might recall when interest rates started going up, particularly at the medium to long end of the curve, we suffered quite significant capital losses on fixed income assets at that point in time, which is when we had the quite significant negative return. But we continue to pay and declare a positive rate, kind of reflecting that smoothing principle. And so, notwithstanding at the height of the uncertainty that COVID generated, where we did have to pull the crediting rates down to zero from a risk management perspective at that point in time, rates have come back up, and notwithstanding, we're also a little bit below, declaring a rate below where the investment portfolio has earned this year. It kind of reflects a little bit of a smoothing of that 2020 2022 results. So going forward, I do expect, given touch wood, hopefully interest rates start to stabilise, which they seem to be doing. I do expect that the funds will be able to continue to pay and hopefully increment up the declared rates gradually to reflect that more stable interest rate and more supportive environment, to be quite honest. So that's a key dynamic that we manage the portfolio by. You can see very clearly coming through that history of returns. The other point to note on this slide is that on the right-hand side, you can see the table that over the 10 years, we actually have declared more than what we've earned on the investment portfolio, and that primarily reflects the additional distribution from the inherited estate that has occurred over that period. So that's effectively that 45-50 basis points declared rate over the last 12 months. So one of the benefits of this portfolio is we do have the estate. It does provide some significant capital support for us to provide that very attractive downside guarantee, and we do distribute that estate over time for the benefit of all policy owners as well. So that explains why the portfolio has effectively outperformed its underlying investment portfolio. If you move to the next slide, I mentioned a bit about interest rates, and this portfolio really does have a strong driver based upon what happens in the bond market. And certainly over the last 10 to 15 years, we've been in quite a supportive bond market environment with rates declining, broadly from that kind of 5-6% level down to 1 or so percent level in COVID years. And over that course in time, the declared rates have broadly reflected the positive capital market, capital returns that have been earned on the fixed income assets in the portfolio. And that period was quite supportive for that reason. The last few years have been challenging in an upward interest rate cycle because the underlying portfolio does experience losses. However, as I said before, we do expect as rates stabilise that those returns are starting to come back into the portfolio. And in general, I would say that PAR portfolio, the capital guaranteed funds, generally should support better outcomes in moderate to higher interest rate environments. I think capital guaranteed funds across the board struggle when interest rates are very, very low. So it's quite positive that we actually have not stayed in a very low interest rate environment for any extended period of time, like other countries have, for instance. So in a nutshell, a pretty good outcome. I'd say the forward-looking view on the portfolio is quite positive, and I think the performance of the fund is very much continues to be in line with the expectations around ensuring there's upside participation, a floor of 0 on what those declared rates can be at any given point in any year, and smoothing of the declared rates over time to provide a bit of a buffer in the underlying investment result. So overall, we think it's providing a very, very strong risk-reward trade-off, which I think is shown quite clearly on the next slide, if you want to flick to it, which I'll hand back to Scott to talk through how the portfolios perform relative to some of the comparable asset classes.
Thanks very much, Josh. So as Josh said, on this slide we can see the performance of the capital guaranteed fund in the first table there, the top line, and then below that actually the performance of the underlying assets that support that fund, the investment assets. And the point to make here really is that when we look at the second column drawdown, of course policyholders don't receive any negative return at all because of the capital guarantee. However, if we look at the investment assets underlying, we can see that late last year there was a drawdown in those assets. If you remember the environment where it was expected or it became known that inflation would be a little bit trickier to maybe decline than might have been expected, and as a result, cuts to interest rates have been pushed further out, and that had a negative impact on markets, both in the markets that are part of the investment assets, but also in the second table there. If we look at markets more generally, actually that first line cash, the bank bill index, that also didn't sustain any losses. But once we look at the bond market, so which is represented by that second row of the second table, the composite 0+ year index, that did suffer a loss of almost 3.5% in that period in markets late last year. And in fact, the bond market overall for the year underperformed what the capital guaranteed fund delivered. And as we can see, when we get into riskier asset classes further down on that table, the equities markets did experience quite significant drawdowns. Again, not a feature of the capital guaranteed fund. Maybe we move to the next slide, please. So just to move towards the fund more generally and to provide an update, just in terms of the asset allocation, there's been no change to the strategic asset allocation. It is a 70% defensive, 30% growth-oriented allocation, which, as Josh has explained, has delivered returns over the long term, and we expect it to keep meeting the objectives of the fund going forward. Just in terms of the underlying managers, it has been a tricky market in convertible bonds this year, and so Lazard has slightly underperformed its benchmark. However, any impact of that has really been offset by Janus Henderson, which has had a very strong year in the bond portfolio, which comprises the majority of the underlying investment assets. Just finally, I will mention the interim rates. So the interim rates that apply for this coming financial year are shown in the table here. Just a couple of points to be made here. One is that these rates are set conservatively, since the prospective returns, until the declared rate is declared next year, are uncertain. The second point to make here is that these rates are not guaranteed and can change without notice. So with that in mind, we'll just move to the next slide. I'd just like to finally just wrap up on the asset allocation of the fund. As I said, it's an unchanged 70-30 defensive growth split. And you can see the underlying investment managers that we have there. On the one hand side, Janus Henderson, as I said, had a very strong year this year. BlackRock actually met its index as we expect from those BlackRock products that are index driven. So with that's the end of my prepared comments here. So perhaps just move to the next slide and we'll see if there are any questions at this stage. As we explained, there will be time for further questions at the end. So perhaps for now, I will take this opportunity to welcome Shan Kui from Janus Henderson. Shan is Portfolio Manager Credit at Janus Henderson, and as I say, Janus plays a large part in this fund, and we're delighted to have him present today. Thanks, Shan.
Thanks very much, Scott, and lovely to be here to speak to you all again after this financial year end. I'll just go through a very brief review of market returns over the last 12 months and over the bond market of the past 3 years. And then we'll really focus on an outlook for the Australian macroeconomy, and we'll welcome any questions at the end. So just over the page, we're all familiar that it's been quite a volatile period within bond markets and some of the investments that we make on behalf of the fund. If we look at the past 3 years, we have seen quite a rise in bond yields, as Josh alluded to. But if we focus more on the last 12-month period, there have been large swings in market pricing of bond yields. But the overall trajectory has been one of relative stability point to point. 10-year bond yields rose 30 basis points in the last 12 months over the financial year, which compares to about 40 basis points in the 2023 financial year, and then a very swift and sharp rise in the 2022 financial year. So we characterize it as a volatile environment, but bond yields more recently have gone nowhere fast, but it has resulted in a large trading range. If we look at the last 3 financial years together, the Australian bond market is still down, delivering negative 6% on a cumulative basis over those 3 years. Over the page, we look at broader asset classes, and whilst bond yields have been volatile and you've seen market returns swing, and as Scott alluded to, a fairly sharp drawdown across asset classes in October 2023. More broadly, if we look at the whole year, it's been a fairly fruitful year for investors, benefiting from a higher income level from the fixed interest market, but also perhaps less fear than was anticipated around market adjustments to higher interest rate levels around the world, which allowed recovery in some asset classes like domestic REITs, albeit we're still seeing some negative valuation activity in commercial real estate globally. So characterising the period one where bond yields haven't risen substantially, which has allowed some recovery and some positive returns to come through. broader risk markets in 2024. If we drill into the Australian fixed interest market over the page, if we look across the board, some positive returns from that higher income generation, notwithstanding we saw some lift in bond yields over the year. The Australian government market returned 3%, and as Scott alluded to, that was below the return on cash. But where we sought some of our activity and outperformance was in the higher income investment grade credit space, which you can see was one of the top performing segments across this domestic market in the past financial year. Now, if we look forward in terms of economic outlook for Australia, over the page, we look at the overall growth environment. And so we are in a period of sub-trend growth. Quite soft growth on a quarterly basis, but over at the calendar year, we are expecting around 1.4% real GDP growth for Australia. As we can see, the orange sections, which represent the domestic consumer, have weakened, and they remain at weak levels with low consumer sentiment. We do expect 2024 to allow growth to trough, but this outlook for 2025, which we're presenting here, is predicated on an environment where the RBA is allowed to cut interest rates, which will then help support the economy and start lifting consumption again. So you can see on the right-hand side, our forecasts are fairly in line with RBA expectations, perhaps a slightly lower trough this year, and then a swifter rebound in 2025, but broadly in line. The reasons why we're expecting softer growth, softer consumption this year, and then a lead into a rate cutting cycle is over the page. The uniqueness of Australian households in the global context and the transmission of cash rates within Australia. So on the left-hand side, we contrast how much change has occurred in debt service ratios for that household sector versus some global peers. And you can see in the orange line that very swift rise in debt service costs for households across personal lending as well as mortgage lending. That transmission of cash rates is not being mimicked in other economies. The US in particular, the household benefits from 30-year mortgage rates at a fixed level, and their slow turnover and reticence to give up those mortgages has meant that their kind of mortgage interest rates have remained quite low, notwithstanding the Fed has cash rates higher than we do here in Australia. The other thing to note is on the right-hand side, household debt to GDP in Australia is elevated versus other countries. So the combination of transmission and high debt load explains why the household consumer is fairly pessimistic at the moment. Over the page, we look at the Australian private sector. And it is clear the cyclical and some of the smaller businesses across the economy are already feeling the pressure. In terms of business debt and lending rates, small businesses have seen quite a sharp rise in their borrowing rates. And some businesses who had to lever up over the COVID period where we had lockdowns and certain segments unable to trade effectively have now borne the brunt of cost increases in inputs as well as higher financing costs. We're not seeing the same impact across the larger businesses. They had a more dynamic and active approach to managing their debt costs during the low interest rate period. And a little bit more like the US, we've seen their interest costs rise very gradually as they borrowed fixed at lower interest rates for a period of time. But notwithstanding that, on the right-hand side, we are seeing pockets of pain, and the number of companies entering administration reached a record peak in May. And so signs of friction are upon us within the economy. If we turn over the page, something very pertinent for the RBA that we and they are monitoring closely, employment trends and unemployment have been very low. We are seeing, and what the RBA wishes to see, is some moderation from a very tight labour market. And they're looking at across a range of measures. So rather than just focusing on the headline unemployment rate, they look at a range of measures to test the health of the labour market. So whilst on the top line, the unemployment rate remains very low and above long-term average in terms of strength, if we look at the subcomponents and some of the leading indicators, which we have highlighted with red arrows, and if we work from the bottom up, employment intentions from private companies and the private sector have fallen to a more neutral long-term level. So they're not looking to continue to hire that next marginal worker. That's also then resulted in job ads falling to below average. So the availability of jobs and job advertisements has definitely come down. Second line from the top, we're also seeing what is typically a leading indicator for unemployment to rise, is that underemployment has also risen. So those that are willing to work have seen their shifts cut back, or they aren't able to get that additional day of work as companies around the country kind of tighten their cost arrangements in the face of a slowing economy and weaker consumption environment. So that gives us some insight as to the direction or likely direction of unemployment. And we do expect over the next 12 months for unemployment to rise. Over the page, we think about how the RBA takes these metrics into account. On the left-hand side, inflation, and the right-hand side, unemployment. And it's interesting to note, if we look at the left-hand side, that the RBA usually starts cutting interest rates when CPI is actually above their target in terms of the top end of the band of 3%. So if we just look at the start of those coloured lines on the left-hand side, 4 of the last 5 interest rate cutting cycles have started when annual CPI is above 3%. And over the past 12 months, we have seen CPI come down. And as Josh alluded to, it is kind of holding around a sticky level that is slightly above the RBA's target band. But we do expect over the next 12 months for it to traverse back down below 3%. On the right-hand side, we look at various unemployment rates at the start of RBA easing cycles. And so typically, we have seen higher unemployment rates at the start of an easing cycle, with the exception of the global financial crisis. We were at 4% unemployment, and the RBA started cutting quite rapidly. So the combination of the two factors and the trends in those measures can trigger or allow the RBA to start easing. And so we do see an environment where both of those conditions may be met in the next 12 months. In terms of our own expectations over the page, if we focus on the orange line, that is our base case for RBA cash rates over the coming 2 years. So we do see them holding cash rates at the current level through until early 2025, where it becomes a little bit more apparent that CPI is settling and unemployment has begun to rise. We bear in mind in the high case that recent inflation prints have been stronger than expectation, even from the RBA's perspective. And so that may warrant some reaction after the next quarterly CPI print, depending whether it is uncomfortably high for the RBA, and they may need to act. We do see one interest rate hike as a possibility, notwithstanding the market is now contemplating a potentially higher terminal rate. Where the opportunity for investors and active managers comes about is really towards the second half of this chart. So in the market, in bond yields and in cash rate expectations, the market is not expecting the Australian economy to see a below 4% cash rate for the next 10 years. So in essence, the market is pricing in that the current level of interest rates is around neutral, and the economy will be able to tolerate it for the next decade, effectively. Which contrasts a little bit to some of the data that we've seen or presented in the earlier part of this presentation. We do see a cycle from the RBA as unemployment starts to lift. And typically you would see over 200 basis points of cutting. We do agree that this is likely a more modest cutting cycle, but we still expect between 100 to 150 basis points of cash rate cuts. And there is a gap in that expectation that we have versus what the market is pricing currently. If we flip that over to how asset classes are being priced, we did see strong performance from global share markets across the year, and the higher level of inflation and the stickiness and the pondering of the market in terms of higher cash rates for longer has kind of represented an opportunity for bond investors. Both government bond yields and credit investment grade yields have lifted recently again, whilst equities have performed quite strongly, and earnings yields and gross dividend yields as a result have declined due to the prices of stocks. So if we turn our mind to a forward-looking environment of slower growth, rising unemployment, potentially the environment could favour bond markets, as well as funds that feature capital guarantees as we move into an adjustment phase in markets. If we think of looking back over historical episodes over the page, in the last three previous cutting cycles, we've seen anywhere from 200 basis points to 425 basis points of cash rate cuts. And that turns the dynamic that we've seen over the last 3 years in terms of rising bond yields back into a tailwind for bond market returns. So we're hopeful that the environment that does present at least allows for stability of bond yields, if not a slight rally, but there is a potential for a larger capital return from bond markets now that we have reached a higher level of yields. And lastly, on slide 14, one of our favoured segments of the market as an active manager remains in Australian investment grade credit, where the total yield is giving you just north of 5.7% at the end of the financial year from quite a high quality market. And even if we see an environment where inflation does remain sticky and cash rates are held higher for longer, if we think of that period leading up to the GFC, the market in terms of investment grade credit was able to deliver on average about a 6% return once yield levels have risen to this type of income level. So whilst they move up and down and oscillate around levels, the overall income benefit for investors remains relatively positive. So I'll leave it there. Happy to take Q&A along with the team, and I'll hand back over to Nikki.
Thanks, Shan. And thank you to Scott and Josh as well. It was a great fund and investment update and market outlook. While everybody is typing their questions into the chat, which, as I said, the Q&A feature at the bottom of the screen, please send any questions through. I'll just provide a brief housekeeping update about the Asteron Traditional Capital Guaranteed Fund. It is a closed fund available to existing investors only, and in answer to some of the pre-submitted questions, it will remain that way. Existing members can, of course, continue to maintain their holdings and continue to make contributions into the fund. As this is a closed option, it's not available to select on any of our online forms that we are delivering. So you will need to continue to use the PDF version of the forms for investment switches and applications if your clients wish to remain invested in this investment option. The declared rates and special bonuses will all be allocated to your clients' accounts by close of business tomorrow, this Tuesday, 2nd of July, with the effective date of the 30th of June 2024, of course. And you'll see that in the transaction history when you log into Advisor Online. Now, I mentioned that I am joined today by my colleagues in the external advice team, so Stephen, Sean and Dan. Just thought I'd put the faces up on the screen. So for those of you who we haven't met face to face, so you know who we are. Now we're regularly enhancing the advisor offering. You'll continue to receive updates from us on some of the things we're delivering, including some new online applications coming very soon. And enhancements to our retirement reward benefit. So as always, please reach out to the BDM team if you do have any questions. And I will open up to any questions. If anyone has questions for Scott, Sian, Josh, or our team, please enter them in the chat. I haven't seen any come through just yet, so I'm hoping that means we've done an excellent presentation and we've answered all your questions before you've had a chance to submit them. Now, today's presentation has been recorded. So we will be sending a copy of the recording out by tomorrow to you. So please feel free to share it with your teams if there's people that haven't been able to log online today. And I can't see any questions coming through. If there's anybody online, let's give it a couple of minutes. No questions. So thanks again, Scott, Josh, Sian, and the teams at TAL Investments and Janice Henderson. Really appreciate you taking the time today to take us through the fund and market update. As I said, the recording will be sent through either this afternoon or tomorrow morning. So keep an eye out for that on your inboxes. And thank you again, everybody, for joining us online today. Thanks very much.